Yeah, what's up, Bryce? Straps? How you guys both doing? Welcome back to the Change Zone. It's been like a year. Welcome back. Oh, boom. It has been forever. You are absolutely correct. Welcome back, guys. Doing some market updates right now, drafting a script for a YouTube video, and just getting ready to listen to some updates on the housing market and the stock market. If I finish that, I'll be playing games later, but this is just a chill chatting stream so far. I just figured I'd hang out with you guys while I'm doing some work. Yep, coming back, boom. Had to focus on some things with the real estate license and the retail business, and I had a couple surgeries I had to get out of the way, what have you. So I have not touched Destiny since you guys saw me last stream Destiny. I pretty much have solely been gaming on Apex since I last seen you guys, to be honest. Fuck it, let's get rid of this starting soon screen. You guys are already here. What about you guys? You guys still in the Destiny grind? Freaking trolling people, baiting them, murdering them, dominating at the game, and then coming into their chats to laugh about it afterwards. I know you are. Alright, we're going to turn the music down a little bit here so we can listen to the update while I'm typing up my stream here.
In today's video, we're going to talk about affordability because that seems to be one of the biggest questions that home buyers have in this
Control
market.
Everyone.
When will we see home prices?
It's good to know that you guys are still having fun with it, though.
Continue to rise at this pace. It's unaffordable, right? Well, it is, but let's talk about some basic economics before we get into the
it put everything on a halt, man. I got 2 more weeks before I can touch weights.
The common questions that
besides the weight I put on my body anyways, it's ridiculous.
Who can afford these properties? You know, how much income do you have to make to be able to afford a house in this market? We're actually going to.
They told me that I couldn't do anything physical straining, anything that caused me to like tighten up my core. I couldn't do it for like 2 weeks. They just approved me to start, jogging and walking again. So I did like a mile and a half a day. Start that back up today, and 2 more weeks, and then I can hit some weights. So fingers crossed.
We're going to talk about how that translates outside of California.
Fingers crossed, guys. I can't wait to hit the gym again.
United States. To give you an idea of what you will likely
So what I'm working on right now is a script for a YouTube video I'm going to be putting out about solar systems. Put a solar system on our house a few years ago, learned a lot about it. When I decided whether or not I was going to get solar, it wasn't something that I felt like I had a clear direction on as far as information and knowledge. So I want to share my experience so other people can learn from it and grow from that.
How can people continue to
don't be sorry, man. It's part of life. You just keep on moving, man.
I think about quite often as well, because at some point there.
I hope you all have been good.
Relief,
welcome back.
At some point you maximize.
Straps and Bryce, you'll have to kick my ass in some custom games in the future when I decide to blow the dust off of Destiny.
And then home prices crash.
Because I'm old, so I buy the disc.
Home prices will probably moderate.
I know you guys probably don't even know what that is.
Let's take a minute and talk about what's driving the market. Right? We've talked about this many times, and it's supply and demand, right? And until something changes with supply and or interest rates.
So it's interesting how he's talking about like supply and demand, and I'll kind of show you guys why it's interesting. Because he's not wrong. Okay, this is from the Census Bureau of homes built by decade. Okay, so check this out. Boom. Okay, so these blue bars are the homes that have been built, measured in the millions, and the gray bars right here is the population growth. So if you look here from like 2010 through 2020, all right, we only built 6 million homes. Okay, it hasn't been that low since the 30s and 40s over here, but our population growth is sustained above 20 million per decade. So this is why, if you know anybody, friends, neighbors, whatever family members that are looking to buy or sell, especially like the buyers are hurting right now as far as the ability to, find the home. And then once they find the home, by the time they've actually gone and seen it, it already has like 10 offers on it. So it's an insane market right now. Absolutely crazy, crazy marketplace. If anybody on YouTube or Facebook has been saying anything, I just switched over to the multi-stream, so just say what's up again. Getting all the chats switched over, so sorry if it seemed like I ignored you. We love you. Welcome back to the Change Zone. But this is absolutely insane. Like, this graph just says it all, honestly.
Rates, because interest rates is a key driver in that buyer demand. Until one of those two things
is solar worth it. How I ended up paying over $5,000 for my solar system.
Comes into play,
what not to do with solar.
About here.
These are like the proposed titles that I think I'm going to go about.
Seen, very, very low supply, really coming out of when the market started to rise back in 2012. So at the beginning of the housing pandemic in 2020, we were already coming into that year with a low supply of homes. During that time, you had, interest rates, somewhere in the mid 3% range. And when the pandemic happened, the Fed lowered the Fed funds rate, which impacted interest rates. Interest rates shot down to the mid 2% range for a lot of 2020, which gave buyers the ability to purchase more home at that time, right? Because interest rates dropped, they can now afford to purchase more home. At the same time, you had a lot of things playing into the market during 2020. You had people being able to work from home. You had people wanting to move out of the state because now they could work remotely. So they no longer wanted to, stay in high cost areas. They wanted to go somewhere where they could purchase a property. You had baby boomers staying in property, aging in place. At the same time, you had millennials coming into the market, right? The largest pool of home buyers to ever enter the market starting buying property. So you have all of these factors playing into to the home buying process, along with, construction.
So what's your main games? Are you still just about Destiny drops? Is that all you're playing?
Pandemic, because of workers and because of the lack of lumber and building materials and all of these things.
Welcome to the Change Zone. My name is Jacob. I'm a realtor, investor, and extreme motorsports manager.
The interest rate,
extreme motorsports manager or extreme motorsports retail manager. There's a difference, but I feel like the second one is just like too many words.
People are going above and beyond.
You guys are clever. You can figure it out in chat, right? I think I'm talking to you.
These crazy things in order to get into a property, and month over month we're seeing appreciation in most markets across the United States, and that will likely continue until
I get rid of this watermark right here.
And
I changed out my main board and everything like that, and now my Windows keys aren't working. So
sometime in
it is not
2023,
does not like it.
You
keeps
might
kicking that watermark up.
Rise.
I haven't figured out how to get rid of it permanently yet.
A huge supply,
even with new Windows keys, it's not working.
Come to the market at one time. Now, keep in mind, any inventory that comes to the market that would be potentially priced below fair market value in most areas would probably get purchased up pretty quickly by home buyers, by those home buyers that have been, in multiple offer situations and bidding on property. You have those buyers. And you also have investors out there, right? Investors looking
for get rid of word
some stabilization in
a realtor, investor,
and
more sports retail manager.
Are looking to buy property.
Yeah, that works.
So
that's smoother.
You really have the demand isn't going anywhere, right? So with low interest rates, demand's going to stay high. You're not likely to see a huge supply of homes come to the market, but if you do, they're likely to get purchased pretty quickly because of the demand. And so that brings us to affordability, right? What happens with affordability? Because, at some point, as home prices continue to rise month over month over month, you start to wonder who can afford these homes? How many people are left to be able to purchase at these prices?
Hedge funds,
and
LLCs.
That's really what I struggle with.
Answer.
It's not that I expect a huge decline
Parking
in the
their
market.
money, hedging against inflation, probably.
You're going to run out of buyers. But when does that happen, right? What kind of incomes are we looking at here for these buyers? And the one thing that nobody factors in, on the affordability idea is down payments, right? How much down payment are these buyers coming in? Yes, home prices are rising. Yes, there is a limited supply of buyers at some point, but if they're putting in large down payments on these properties and their monthly payment is still reasonable in their eyes because of low interest rates, you know, that coupled with the number of home buyers that are, you know, that are bidding against each other on these properties tells me that you're likely to see, you know, a market like the one we've experienced over the last year. You're likely to see that a similar market for at least another year because, you know, demand is not likely to slow during that time. But you know, that's what's really difficult to break down because we don't know how much money people have for down payments, right? We know that, you know, 2020 allowed savings to grow more than they've ever grown historically. So people have more money than they've ever had. Are they using that for their down payments? It's hard to say, right? Because we don't know. But at the same time, we do know that people that owned homes in 2020 gained a lot in appreciation. And a lot of those people that are buying in this market are those people that owned homes, right? They're selling their properties and they're buying something else. So it's not just, you know, first-time home buyers entering the market. You have a large pool of buyers that are move-up buyers that owned property. They gained a lot of equity during 2020, and now they're able to purchase something, use that down payment, and buy something else. So the affordability question is a difficult one to answer because we don't really know where the money's coming from, how much they have to put down. But at some point, I do believe if home prices continue to rise, you've got to see some sort of pullback in the market, right? We can't continue to have, you know, 4 or 5% appreciation month.
Being both a consumer and a producer on YouTube, I can relate to the feeling that you're being held hostage for 10 minutes of fluff just to get a simple answer at the end for the sake of the YouTube algos. And some vigilante in the comment section retyping the answer saying, "You can thank me later."
A moderation in prices. Prices could pull back a little bit, but I don't think you're likely to see a huge decline in the market, you know, these 20-30% that people are talking about. I think if anything, you'll see small pullbacks in the market, and that'll give people an opportunity to get in. It will also, you know, allow supply to build, right? If people back off the market or demand slows at all, you're likely to see that supply build. And if you have more homes to choose from, you're going to see a couple of things. You're going to see, you know, home buyers not necessarily having to overbid on property, but you're also going to see, you know, more property continue to come to the market because there's a lot of people sitting on the sidelines right now wanting to purchase property, and they look out there and they look at the inventory and they're not ready to sell their house or put their house on the market because they're not seeing homes that fit what they want. So as they start to see homes that, you know, are closer to what they want to purchase, you know, you're going to see their homes come on the market, and that's going to help inventory build. Now, the other side of this is you know, people in California, you know, where home prices have accelerated and home prices are higher than most places in the country. A lot of these people are able to take their incomes from California and purchase in other areas across the United States, and that's been one of the key drivers in other markets across the U.S. is people leaving high-cost areas and moving out to, you know, the Austin, Texas, you know, Phoenix, Arizona, Boise, Idaho, because they're able to, you know, take their California income in a lot of ways because now they're able to work remotely. Some just took the appreciation that they gained in their property and went and bought houses cash. But either way, they're able to take that money that they've gained in California in one way or another and go to other states and buy property. And that's what's caused, you know, this frenzy in other markets as well. And as long as you have people leaving California, which you're going to because of political reasons and taxes and all that good stuff, you're likely going to see that appreciation in those markets as well. But let's take a look at affordability in the state of California, right? This is a report that just came out from the California Association of Realtors. Talks about, different counties, talks about the average income that you need to afford these properties. A lot of you guys ask those questions. How much money do you need to be able to buy one of these homes? Let's take a look at that report here, and gives you a pretty good idea of what is going on. It doesn't talk about down payments, but you also have to understand that when you start getting to these higher price points, clearly you've got to, not only do you need the income, you've got to have the down payment in order to make it affordable. So 27% of California households could afford to purchase the $720,000 median priced home in the first quarter of 2021, down from 35% in the first quarter of 2020. So year over year, you've dropped 8% in affordability, the percentage of Californian households that could actually afford to purchase at that median price of $720,000. A minimal annual income of $131,200 was needed to make monthly payments of $3,280, including principal, interest, and
$3,280. That's a pretty decent mortgage right there, honestly. Figure that out real fast. For that much money, you gotta be talking about. Oh, he's actually calling it a median price home, $720,000. He's just doing that for California. Is that accurate? And priced home for California. I wouldn't have thought it was that high. It's actually it's actually higher now. Oh Jesus. March's statewide median home price $758,990, up 8.8% from February and 23.9% since March of last year. When this all went down and you were trying to get in a house and everybody freaked out and backed out, if you just went through with your gut instinct of wanting to be in a home, call it yours, and ride it out, you would have got 20%. You would have got 20% growth on average plus for the 2020 to 2021. Absolutely.
And taxes on a 30-year fixed rate mortgage at 3%, right? So take that into account there. If interest rates go down, you're going to have, more people in theory be able to afford these prices. If interest rates go up, less people are going to be able to afford at these prices. 40% of home buyers were able to purchase the $535,000 median price condo or townhome. An annual income of $97,600 was required to make a monthly payment of $2,440. So for condos, average price is $535,000, or the median price is $535,000. You need an average income of somewhere around $97,600 to be able to afford that payment. Now, here's the caveat. You don't know what kind of debt loads people carry at those incomes, right? We're just talking incomes here. We're not talking anything else. So housing affordability in California remained at the lowest level since mid-2018 as higher home prices fueled by a shortage of homes for sale pushed the state's median home price more than 22% higher on a year-over-year basis. So median home price went up 22% on a year-over-year basis, resulting in an 8 percentage point decline in the Housing Affordability Index in the first quarter, which we mentioned a moment ago. So California Association of Realtors Home Price Index measures the percentage of all households that can afford to purchase a median price single-family home in California. CAR, California Association of Realtors, also reports affordability indices for regions and select counties within the state. The index is considered the most fundamental measure of housing well-being for home buyers in the state. Now, again, I've highlighted a lot of stuff here. I will leave a link below for those of you who want to read the entire article. Compared with California, more than half of the nation's households, 54%, could afford to purchase a $319,200 median priced home. So the nation's median price, $319,200, which required a minimal annual income of $58,000 to make a monthly payment of $1,450. Nationwide affordability also fell from 59% a year ago. So fell from 59 to 54% with home prices rising here. You need an average income of $58,000 to be able to make that $1,450 monthly payment. Now, keep in mind, you got those California incomes, as I mentioned, that California appreciation money moving into these markets. You've got way more people that can afford to purchase these properties than just the people that live in those areas at the moment. And that's why people are pushing those home prices up in a lot of these areas. Affordability fell from a year ago in all Southern California counties, with Orange County being the least affordable, 20%. So I'm in Orange County, the least affordable in Southern California. And San Bernardino County being the most affordable. So any of you that are local, you know that a lot of people have, are transitioning out of Orange County into Riverside, San Bernardino County, because home prices are less. It's more affordable. And what's happening there is home prices there are rising at a rapid pace because, again, you have all of these people leaving this area, fleeing there, where, it's more affordable for the time being. How long will that last? That's hard to say. In the Central Coast region, Santa Barbara County was the least affordable at 14%. During the first quarter of 2021, Lassen remained the most affordable county in the state, followed by Kings. The minimum qualifying income was less than $64,000 for each of these counties. Lassen also had the lowest minimal qualifying annual income to purchase a home at $45,200. Mono is the least affordable in the state at 3%, with Santa Barbara at 14%, Monterey at 17%. So each of these counties requiring at least an annual income of $157,600 to purchase a median priced home in the county. San Mateo remained the least affordable county in the state and required the highest minimal qualifying income of $337,200 in the first quarter of 2021. It was the only county in California that had a minimum qualifying annual income of over $300,000. Talking about median home price, monthly payment, and income that you need. So Los Angeles, last year it was at 31%. So you can see, the affordability is clearly falling here. The median price in that market is $682,360. That works out to a mortgage payment of $3,110. You need an annual income of $124,400. Orange County, affordability has gone down, but not a lot since last year. And Orange County has fallen from 24% to 20% since last year. Average median home price $1 million. Equates to a payment of $45.60.
I left my drink in the other room. I'll be right back. You can see
the rest of the counties here. This goes through all of California. If you're interested in that, you can check it out. You can check out the link below. But the question comes down to, how long can this continue? Well, it will continue until you run out of home buyers at those prices, right? And as long as you have multiple offers on property, people continuing to outbid one another, things aren't going anywhere unless something happens with interest rates and or supply. And I think we both, know that neither of those are likely to change anytime in the near future. So, the question becomes affordability, right? At some point, affordability will be the problem here as home prices continue to rise, because I don't think you're going to see a change in supply or interest rates in anytime soon. The scary thing to me is watching home prices rise so rapidly, because you're really pricing buyers out of the market, right? The first-time home buyers, the entry-level home buyers are really feeling the most pain here, because those are the properties that are really the most desirable for most people out there, right? There's just a bigger demographic, more demand in those lower price points,
okay,
which means more competition.
So I will be addressing
those home prices arriving.
So I'll be addressing, in my opinion, is solar worth it? How it went for me? Would I recommend it to others? If you appreciate a quick answer, straight and to the point, and want to help be a part of the growth with this newer channel, please smash that sub, like, and notification button. So here it is. Short answer, in my opinion, is yes. Pending some stipulations that I'll go over, I would say solar is worth it. If you are able to lock in a contract or purchase solar with a system that either, one, provides 110 to 120% of your kilowatt need or usage, or two, locks in a lower rate with your utility company. So a lot of times when you hook it up to the grid, the utility company it's going to basically charge like a rate to keep the account open, normally like around $10 or so. And then the solar just gets ran through that company, essentially. And you'll either pay the solar company for the lease, or you can pay the utility company for the power used off the grid if the solar doesn't compensate enough for that. So to confirm this, personally, I would go forward. Let's see here. Oh, I butchered that sentence. Confirm this, I would personally go forward, would not leave it. Okay, so basically, oh man, I need to delete that whole sentence. But basically, I would not leave it up to the solar company to confirm whether or not you're locking in a lower rate with your utility company. I would go straight to the source. I would go to the utility company, I would call them up, and I would just be like, hey, I'm putting solar on my house, and I'll be running it through your company, and I want to know, does that change my base rate? If, for some unforeseen circumstance, my solar system does not produce enough power, is my rate going to stay the same as I'm already paying without solar? Or do you have some different sort of base plan for people with solar systems? Basically you can change your plan, and it's not always in a good way that it can change your plan. I'm going to retype that sentence.
And to me, that is the scary part is how first-time home buyers are going to be able to enter the market, as prices continue to rise. It's one of those things that it's difficult to answer, and I don't think any of us have the answers. But I just want to bring it to your attention out there that the one factor that I see playing most into this market is the affordability, more so than anything else anyone is talking about.
It's a good point, affordability. But I mean, normally when you're looking for a house, though, in general, you can reverse engineer it based off of the mortgage that you're wanting to have. So therefore, I don't know. I guess like with the housing prices rising so much, his argument is eventually you're going to reach a point where no one can afford it. But I feel like there's always a market for somebody out there. So many people in the world, I can't imagine there not being a buyer in a certain circumstance. The houses sit on the market, but then again, that's just rule supply and demand. Like if your price is perceived as overvalued, it does sit on the market longer, and the longer the house sits on the market, the worse the prices that you typically get it. That's why pricing for your house and real estate is so important, to get a good estimate right off the bat. Okay, so let's here, what's the next one? Let's listen to the market update this time.
Here, Palantir. I'm just kidding. We're not gonna.
So he's just gonna recap the Palantir earnings call.
Crazy ride we had yesterday.
I believe.
But first, I gotta say good.
Yeah, record-breaking quarter.
Daily allegedly squad. I've been seeing your comments, watching daily. Thank you so much. My name is Tom. I'm your friendly former senior financial analyst, currently a full-time YouTuber.
Personally, I would not leave it up to the solar rep to confirm this.
Deeper dive into some of
I'll
the
check
issues
with the
we did
utility
not get
company.
to cover yesterday. So here's the thing. I don't want you to click nothing. I don't want you to smash nothing. I don't want you to buy, unsubscribe. Just give me your attention, because I'm about to talk about important stuff. Now, I don't hold you hostage, so here are the topics in advance, and I'm going to give you the bottom line as well. So first of all, I will explain with a numerical example why Alex Karp is selling. The whole insider selling narrative of Alex Karp, I'm going to go through an entire numerical example showing you why he has no choice but to sell shares right now, even though he doesn't want to. And once I do that example with you step by step within 30 seconds, you'll see. Because I explained it yesterday, but I feel it was very amorphic. It was very intangible, so to speak, right? I'm going to give you a numerical example to show you how the mechanics work that actually force him to sell. It's quite easy to see when you put in numbers. The other thing I feel we didn't get to cover yesterday is the quality of the financial results and the business results. We're going to go through the presentation, and I'm going to show you everything they've done this quarter, which is nothing short of phenomenal. Now, in my video yesterday, I said they hit expectations because, frankly, expectations were very high. But that doesn't mean that what they did was not remarkable. If you look at their numbers deeply, like we're going to do in this video, by the way, I'm not sure deeply is an actual word, but as a Russian, I get to get away with that. If you go deep dive into the numbers, you're going to see that they're on a phenomenal path. And that, I think, was the contributing factor to the massive upswing we had yesterday, because a lot of these retail investors basically said, oh, damn, the stock is actually performing well. Wow, look at these numbers. So I think that we deserve a deeper dive into the actual numbers, the growth numbers, the financials. So if you're into Palantir and you want a little bit of a deeper dive, that's probably a better video for you today, instead of just the actual numbers we all kind of know in here, more analytical. And here's another piece of news which is kind of interesting.
Does anybody else listen to YouTube in like times 3 speed?
Use Kathy Wood in my thumbnail.
I don't really have times 3, but
buying the dip as well. I bought about 10% more of Palantir to increase my holding. I mean, I love that company. She loves it even more. Yesterday,
I thought about buying more today, but the other day it dipped even further, so I was figuring
just yesterday. So I was buying my little 10%. She was going all
I'm gonna wait and
in,
see.
lover.
It's either gonna make a higher low,
or I mean, she loves the company.
It's gonna butter through again. I'm curious to see what it does.
One of her high conviction stocks. She said that once things go a little bit wide and the tech sector will pull off, she'll be consolidating. It seems that she's
see how the market did real fast.
Tesla, Palantir, and a few other companies, which is quite interesting, but doesn't really justify a whole video. Let alone a whole thumbnail about that. So we're gonna keep it professional, no clickbait Kathy today. So check this out. So first of all, the numerical example of why Alex Karp absolutely has to sell his stock. Check this out. So whenever you have a professional CEO or somebody you want to retain in the company, it's very customary to give them a package. Not that kind of package, get your head out of the gutter. Package of options. Essentially, every quarter you have a certain amount that's awarded to you. And as the price of the stock of the company keeps going up, that option is actually worth more. Now, as the stock keeps going up, the original price at which he got the options, let's say
I found a nice support today,
is now differentiated versus the market price. Let's say 200 per share. So he has that benefit built in. And at this point, you might say, well, that's a benefit. He has a built-in discount to buy shares at less than the market price. Phenomenal. Well, not exactly, because every ESOP grant, ESOP meaning employee stock options, essentially you have an expiration date. They come with strings attached. You gotta.
This is the company he's talking about right now.
Otherwise, these options will expire. That's very normal. However, when you get to the expiration date, you have a decision to make, because you have to pay $100 to.
That's why everybody's freaking out right now. It's creating like head and shoulders pattern.
You gotta pay tax now. When you have a 200,
I think everybody's just getting a fat discount right now on these growth and tech companies at the moment.
You already have $100 built in as taxable income. Essentially, that is capital gains. And if the long-term capital gains rate in the US is 20%, which it is, then you have another $20 to pay. And here's the case. You just spent $100 per share, including the $20 for tax and another $100 to exercise these options, since you don't have a choice since they're about to expire. But you got $0 coming in, so no money to actually pay for this. So you gotta sell shares just to pay for these option grants. And that's, unfortunately for the Palantir shorts,
oh man,
that's the sole reason Alex Karp has been selling shares. However, if you take a look at the sales numbers, he's still holding about 80 to 90% of the shares. He didn't really sell off. Neither did Peter Thiel. I mean, that's just nonsense. So in general, the whole narrative of insider selling is now completely debunked after the Q1 call, and I absolutely love that. Now, let's go over the presentation, because there's a lot to cover there. But the first thing I want to show you here, which is quite interesting, is the adjusted operating income. The company had adjusted operating income of $116 million in Q1 2021. And if you compare that to the number they had in the entire 2020 year, they already reached 61% of the entire net income of last year in a single quarter. Now, these numbers, when you give them that context, mean a lot, because 116 is just a number, right? But when you did 190 through the entire year last year, you already did 116 in one quarter. That means a lot. And again, in these videos, I don't want to just read off the page. I want to give you extra context so you actually get the full picture, not just these numbers. So check this out. Now, first of all, this number in itself is quite impressive. 44% adjusted free cash flow margin. That is wild. However, that's even more interesting. Look at the path they went through. So they lost $300 million in cash flow in Q1 2020. However, they made 151 this quarter. So that means they shifted from losing $300 million in cash burn rate, right? From the first quarter of last year, they went from losing cash, burning, whatever you want to call it, $300 million per quarter last year in Q1 2020, to making 150 per quarter positive as far as cash flow. That happened in a single year. And honestly, I can think of a lot of companies that can make this happen, going from negative 300 to positive 151 quarter over quarter, year over year. That is Tesla level numbers or Tesla level improvement, whatever you want to call it. Not saying that this is Tesla. I'm saying this is hell impressive. Now, this number, everybody expected. Their revenues grew by 50% versus Q1 2020. Now, because it was kind of anticipated, people tend to overlook how impressive that is. You got 50% growth in revenue quarter over quarter, year over year, which is nothing to be ashamed of. That number is phenomenal. From 230 to 340. Not to mention that they actually beat the expectations by about 10 million, but that's a really impressive growth. But wait, there's more. Now, this slide is impressive on many levels. First of all, most companies won't share this data because it's too complex, but they actually did. Beyond the fact that this number is insane. So their billings per quarter grew from 104 to 362. Now, just when you think that billings is some sort of a technical thing, it's not. Getting people to pay you what they owe you is not that easy. It takes a lot of work, and it actually shows a lot about the quality of customers you're working with. If you're able to increase your billings from 104 to 362 year over year, quarter over quarter, that means that A, you know how to do your job as far as billing. Number two, that your clientele is AAA. The only way to get this amount of growth in billing is by having phenomenal clients and a really good team. That means a lot to me, even though a lot of people will overlook this number. Now, this number is not that impressive to me. I know a lot of people will say, well, that's 81% year over year growth in the US revenue. That's fine, but you have a lot of concentration here. That means that if you grew 49% globally and 81% in the US, that means that the US is essentially where your powerhouse is. I'd like to see this company go global. And that means that this high number is actually a sign that they're not there yet. I'm not saying that they won't be. Yes, you know me, I'm a huge bull, but I'm saying 81% when the entire growth is 49, that means you have a lot of work to do internationally. And that's fine. I think they're definitely on the path, but I'm not going to be sitting here and, just licking their bum because I like the company. I'm going to be pointing out the things that I don't like. And 81%, given that 49 is the entire global ROW, that means that this number is way too high for my taste. It definitely needs to be spread around more evenly. Now, this slide
This is eToro, the leading social trading platform with over 13 million users worldwide. We make smart crypto trading easy, offering users the ability to buy and sell the world's top cryptocurrencies, including Bitcoin, Ethereum, XRP, and more. Check out what other
Oh, thank you. That's trending. That would work. That would be such a good meme. That face, though. I mean, you can use it if you just use like 2 seconds of it, right? You think they would copyright claim it, or the DMCA, or what is it, DMCA rights over just a couple seconds of a song like that? No.
As impressive as it is, it's nothing
We'll come
to
back
write
to
home
that.
about because A, we anticipated that, and B, we know that they're very strong with governments.
Jesus,
We're
I'm so
looking at the
tired. It's already
commercials.
setting
This
in.
thing, not surprising. They're probably going to do the same percentage next year and next quarter. They're very good with governments, especially with the US government. So that part, we got it covered. That's the basis. We want to see the growth in the commercial actually hit these numbers, the 76 to 80%. That's still not there yet. This is actually also very interesting. That's the backlog. Essentially, they have 5.4 billion.
How do you
Oh
turn
no,
a
the
best
commercials.
bed into the best bed? A dorm bed into a dream bed. Simple with the
In total remaining deal value. That means that's cash flow they're going to collect on the next few years.
Okay, let's try this again. So, short answer, So short answer in my opinion is yes. Leasing or owning solar, like many investments, really just comes down to the numbers. If you can lease or pay a rate at 75 to 80% of your current utility bill, it seems like a no-brainer. Remember gas under $1? Yeah, it was a long time ago, but it was there. Well, what do you think is going to happen with the rates of electricity over the next 5 to 10 years? You guessed it. It's going to go up, up, up. And pending some stipulations that I'll go over, I would say solar is worth it. If you're able to lock in a contract or purchase the solar system with either one, or that either one provides 110 to 120% of your kilowatt usage, or two locks in a lower rate with your utility company, that would be ideal. Personally, I would not leave it up to the solar rep to confirm this, or even pitch it to you, or even believe it in some cases. Call your utility company, let them know you're going to throw that solar system up on the roof, and you want to confirm how it will affect your rates should the panels, for some unforeseen reason, not produce enough energy. Some of them may absolutely shock you when they explain hooking up the solar system to the grid will change your base plan, and not always in a good way. Sounds better.
Years on project they still haven't collected on. That means a lot as far as their growth. Imagine having a business that actually gives you 5.4 billion of bill flow when your entire revenue for Q1 was 340 million. Imagine how massive their future is. This is insane. Now, this is where I want to see more improvement. Total commercial growth 20%, which is very nice, but nothing I would say, wow, that's amazing. We want to see higher growth here. This is the commercial customers. So 19%, that's very nice. But look at this, 72% came from US commercial customers. We gotta see more global, we gotta see more commercial, and we gotta see a better spread, not just 150 customers. We gotta see this thing go scalable. That's the main stepping stone these guys have to go through. So for me, that number is nice, but nothing outrageous. This thing, even though it looks great, I think it's a sign of weakness because it essentially says that the top 20 customers are generating 34% more. That means high dependency in your biggest 20 customers, which is something I don't want to see. I definitely want to see revenue per customer go up, but I don't want to see the company become so heavily dependent in the top 20 customers because again, that makes it look more like a consultancy and not as a scalable business, which I'm sure it's not. I'm sure it's a scalable business, but these numbers are definitely something they need to work on. Now, this is wow. Now, if you want to talk about wow moments, this is it. 83% adjusted gross margin. Contribution margin equally as impressive with 60%. By the way, contribution margin is essentially also when you take out the variables. So all the variable costs come down, still 60% margin. Wow, that's very impressive. So there you have it, ladies and gentlemen. Nothing fanboyish. I told you the good, I told you the bad, where they need to improve, where they were really impressive, and in general, my total impression based on that. As always, a huge thanks for our channel members and our patrons. Thank you so much. I really appreciate your support. We'll see you guys in the next video.
Meet Jonathan and Kathy. When they brought little Cooper home, we were there. When he took his first walks, we were there too. And when this happened, Ring and Alexa helped them act fast, letting them know there was smoke in their home. And John was able to rush back and rescue Cooper. Together with Ring, John and Kathy saved Cooper and their home. To see more incredible stories like this, visit ring.com.
We got for the next one. Clickbait. Oh, here we go. I want to figure out a little bit more about why this stock market had such a bleed today. See. This guy's entertaining in the mornings. Fear how I feel, then it feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
All right, ladies and gentlemen, I got your watch list coming in on May 13th, 2021, and we need to talk about why the stock market went down today. And I got 3 stacks that I'm looking at coming in tomorrow, but today was another wild day. We got the report in the morning. You could see the pre-market had a big drop, then we held up, and then all day was a slow drop, even though we broke through some key levels. Now, bring this up to the daily. This brings us right back to the start of April, and that's where we kind of broke out of the February-March zone. So this is an interesting level. I got a lot of things to talk about. I'm going to go over the CPI report. I'm going to go over one of my leading global indicators, and last time I seen this thing trigger was, well, March or February 2020. So got some cool stuff to show you, but at the same time, there's going to be a lot of little stuff that we're dealing with throughout there, and I even have a prediction for tomorrow and what I'm expecting. Now, I will say this. Today's been pretty big. It has some drama. I think it's setting up some short-term, mid-term opportunities, but in the overall, even just yearly view that we got here, and even pushing it beyond with what we saw today with that report, I'm expecting some volatility, but I'm not really getting too bearish or too, oh my gosh, this is the big one. So we got a lot to talk about. Want to go over all of that, what happened in the market today, what we're looking at tomorrow, the plays that we made today, and I made quite a few, and then the plays that we're looking at for tomorrow. So let us not delay. You guys know what you need to do. Drop your thumbs up on the video. Make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open. It's the first.
So if you're here for the thumbnail and you're wanting to know how I ended up paying over $5,000 so that you don't have to, then grab some popcorn and a chair. It's story time. But if all you wanted was to hear my answer without the backstory, that's it in a nutshell. Feel free to go on and join your day. But if you're super awesome, we'll set your phone down and let the video play out as you dominate your day.
Shout out to Chad, baby. So right off the bat, the main thing today was the inflation report. We've been talking about this. It came out today. I'm sure you've heard all of the numbers. It came in above expectations on both the core and the normal CPI. So it seemed like it was priced in and it seemed like it was in line. However, if you look at the numbers, even from the highest level of expectations, the results that came in were about 20 to 40% off, with the core CPI being the biggest increase or the biggest surpriser if you want to look at it. So the real point to all of this, you will see a market reaction. We need to talk about the digestion. This is going to take a few days, but now you got the huge jobs miss last Friday. You're seeing noticeable inflation, excluding energy, food, and even assets like real estate and all of that, and also your stocks. So what is this equaling? It is short-term headwinds, and now, well, you're going to see if the fears are going to develop or not. If you're looking for this simple version, it's essentially this: prices are going higher, and then economic activity is not going up with it. That's why the jobs report was low, but now you're seeing noticeable price increases. Now, a lot of people talked about automobiles and even the baseline effects comparing year over year. I will show you the actual CPI, and even though autos did have a big price increase, we were talking about this, where used cars actually go up in value. It's a weird world we're living in right now, and given the amount,
this is what I was talking about this morning, about if you have a used car and you've been thinking about selling it, now's the time to potentially think about selling it.
Had a really
all-time highs for used vehicles right now.
The problem is you really
might
saw
actually
that effect
get out ahead on it
as well. So it wasn't just the autos that saw a 10% move, but even travel, the price of cigarettes, as well as some other services, even medical. So the point I've been saying is that, yes, it's showing you why you could try to kind of justify this, but the point is these assets shouldn't move. Even the core CPI, this is the biggest increase that we've seen since the 1980s. Now, granted, we've been going through COVID and all of this other stuff. The point is you're seeing a financial and economic effect taking place, in a big one. And now the question is, how do investors respond, especially after taking in everything we've seen this year and even the last year? So this is the actual CPI report. If you go to the Department of Labor statistics, and you can see they have the report, but now if you come down here, you can really see by industry and have it broken down, not only just what we saw here, but they give a seasonally adjusted change, as well as the unadjusted, and then even looking at it, comparing it from 2020 year over year and all of that. So when you even come and look at some of the unadjusted increases, it becomes really easy to see the price increases all across the board. Again, this is from April 2020 to April 2021, so that has some baseline effects. So although autos was very big, you come to energy, that was one of the biggest, with commodities, motor fuel, all of that. Again, you get to see some bigger increases with food as well, but now everything from even basic commodities to tobacco, now even to airline travel and even lodging, and the price
It's all
to stay at
inflated.
hotels, that all went up. So even if you come and look at it on the seasonally adjusted basis, that's where the autos shine through, and then it kind of waters down some of the numbers. But then traveling and all that stuff, it is coming back, and there's certain areas that are going up. So hang with me here for
Used
a
cars
second,
and
because
trucks
this may seem
up
like, okay,
10%.
these numbers went up, why are people reacting to inflation? Well, you've already got to see this at the beginning of the year. Now, there is some global tensions that are rising right now, and I do think it is important. It also does correlate with price stability being unstable. However, the economic data right now is the most important. Essentially, if people start expecting more inflation, and even after today's report now, all the economists who had their expectations last month, they saw it get blown out of the water today with that report. Now, a lot of the future expectations are going high.
All right, break time. I gotta let the dog out. Be back. Trying to chew on everything. Very troublesome cat. Okay. Back to the keys.
Higher and higher. So depending on how the market and investors react, that is literally going to be an exact repeat of what we saw at the beginning of the year with bonds. So I don't know if you guys remember, you know, you were going through the GameStop phase, all of that. You saw rates started to creep up the whole month. They kind of stable out here. Then towards the end of the month, you had the GameStop situation, all that. And then all of a sudden, the rates started climbing very aggressively. People didn't react too much. They were a little confused. People in the mortgage industry started making jokes. There was still a little bit of the euphoria and all of that, and then now you start coming into February. This is where now a lot of this stimulus and other stuff started to get passed. Executive orders, policy really started to speed up at that moment, but now at the same time, people started getting worried about inflation. And this is where you saw the rates go up. This was the first time the NASDAQ started getting scared. People were saying, wait a minute, how does high rates start impacting some of these tech companies, all of that? So I could make a whole nother video on that. But if you guys have been paying attention, it will make sense and we'll get to a lot of it here. But overall, as some of these expectations and plans of higher rates continue, especially after what we saw today, and now you need the digestion, you have to factor in that poor jobs report. This is going to be the most important thing to watch moving forward and how those expectations change. Now, that is the Spark Notes. As far as tomorrow, I'm expecting a gap down, but then some sort of pop pretty early on, and then after that pop, come and test the lows. You've heard me talk about this a lot today. I thought we'd even see it today or yesterday, but you kind of got a taste of it Monday. However, now at this key level with that 400 level on the S&P, you got a little bit of a crack in the Dow. This is what I want to watch, but today was pretty controlled. Premiums did go up on the puts. The only time you really saw them actually get real crazy was when there was big velocity. So if the velocity is slow here, it's going to affect the pricing and puts, and it may make an interesting scenario here. Again, I would even blame inflation for that. So I could be wrong on this prediction. I am going to see again. I think it is very confusing because you really don't know the extent to which investors are going to interpret this data. And what I mean by extent is pretty much how much more inflation do they really expect, and how do they put their money where their mouth is to reflect that with their purchases? Because now in this inflationary environment, selling doesn't always make the most sense, and then buying stuff at a premium doesn't always make sense. It gets really confusing, and that's why it could end up being very chaotic on the market and a lot of other people as well too. But nonetheless, Friday is going to be the wild card. That's what I'm going to be looking for. But just like we saw with the jobs report, this is going to be a multi-day digestion. So what I'm really going to be watching for is any key inflation indicators like oil and even crypto. And I know some of you are getting sick about hearing about all the crypto, the Ethereum Classic, Stellar, all of this stuff. But at the end of the day, this was one of those inflation indicators we looked at. You don't have to trade this, but you could even look at this and learn something here. But this was May 7th, the jobs report. Pretty much since that report, even after today, Ethereum went up almost $1,000. That is about $100 billion in market cap since the jobs report first came out. So you literally saw this as a digestion. Even this morning, after the CPI, it started running and outpacing even when the market was going down. So keep your eye out for this, even stuff like oil. But now here is the final thing I'm going to show you, my last leading indicator, and it is not crypto, but the Japanese yen. Now, this is usually a safe haven currency, and if you remember from the first little bond fiasco this year, you could see the yen weakening up here. But now, a lot of people brought up the demand. Even David Tepper said the Euro-Japanese demand will be strong for our bonds. That might just change here, and this is what we see in the currency, because pretty much last time the yen weakened here, the dollar was at the high point of the year. Now the dollar's coming off the low, so even though the dollar got a little bit of strength today, which seems kind of counterintuitive to some people, that's because today was more of a shock day than showing the broader trend over the last 6 months. The real key here is if the yen starts weakening, but one thing it did today was just that. But if you start seeing this thing go up, it literally led the February, April stuff, and it was a little bit more muddied because there was a lot of other stuff going on, and you kind of seem like every other currency did this. But now, the point being is that Japan is usually a stable currency. It is literally a safe haven currency. So in times of difficulty, you would actually see the yen want to strengthen strengthen as opposed to weaken. And like I said last time in like February 2020, when you get any of these weird weakenings, when it seems like there would be a climate where people would want that safety and security, this could point to some more liquidation. And now that's also what we saw here today. Although today had to do with the inflation report and all that, you even saw Taiwan's stock market drop more than any time in the last 52 years. It was 9%, but some people are arguing that was based off of COVID cases. Now, I brought this up yesterday with global tensions and how if it kind of spills over, what I'm really looking for is inflation contagion. So that I'm making this up, pretty much it's contagion, but related to the inflation, I feel like we're going to start hearing about that in a little bit. So either way, there's a lot on the table. There's a lot that we need to see. Stuff is going to digest, but it is creating opportunity, and I encourage you to look a little bit ahead and take advantage of what's ahead of you. But that is pretty much it. So let us get into the play.
All right, guys, I'm going to take a break from doing the live broadcast, do some recording here for a YouTube video. If I finish it up tonight, I'll come back on and shoot, play some Apex with viewers or what have you. All right, thanks for chilling while I did the market update on the stocks and the real estate. I finished writing up the script for the YouTube video, and